I'm very excited to see the moving averages which you have plotted. I can, if I'm not wrong, it's 20, 50, 100, and 200, right?
Exactly.
And you will be, pleasantly surprised to see exactly the same template which I use, except I use 21 moving average and 55 for short term and 100,
Sure.
200. So this template looks quite uh, similar to me. Very, very good to see. So could you explain the relevance of all these four moving average in your setup?
Yes, the relevance for me is my time frame. So the 200-day moving average for me, which is the green line, that basically gives me the primary trend. So if we have a rising 200-day moving average, and we'll take a look at a market with a rising 200-day. So this is the energy sector ETF. So what the rising 200-day signifies to me, primary uptrend. And then I'll use the 20-day and the 50-day more for entry and timing. I don't really use the 100-day too much. I keep it on there for context, but the 20-day, the 50-day, and the 200-day, those are my three key moving averages that I look at. And then I look for very, very simple things. Is the 50-day moving average rising or rolling over? Same thing with the 20-day. And ideally, I like to see all three moving averages going in the same direction, either turning up, or if they're rolling over, that tells me that's something that I want to avoid.
Okay. So when you say rising, that means you're looking at the slope of 200-day moving average. So when do you conclude that the moving average has stopped rising and the moving average is sloping down now? Then you decide that I should exit?
No, what I don't exit off of the slope of the moving average. So primarily what I'll use is either a fixed moving average, like the 50-day or the 200-day, or I'll use just a fixed percentage stop. So if I take a new position, I might just run a basic 10% stop or a 12% stop based on the volatility. But I do like to understand the trend that's involved. So a new position, just to give you an idea. So a new position that I just took this week is Occidental Petroleum. And I took it just coming out of this base. So it pulled back into the 50-day. It held at the 50-day, started to move higher. So I took that position. But what I see on the chart is a rising 200-day. The pullback held the 50-day, and now the 20-day is rising, and it just crossed the 50-day to the upside. So all of those factors for me are technically very bullish in the trend.
Okay. Larry, if the price is retracing or it is going down, ideally 200-day moving average should also at least flatten, right? Or it should start trending down.
If the 200-day, yes, if the 200-day starts to roll over, that's a concern.
Okay.
So if I see a pullback over the rising 200-day, then that tells me that's a pullback that I might want to try to buy into. But if the 200-day starts to roll over, and we've seen that, for example, in the NASDAQ 100 for a while, then now this is a primary downtrend. In the NASDAQ 100, we've got the 200-day rolled over, the 50-day is rolled over. Now, the NASDAQ 100 is trying to put in some type of a near-term low with the market, but it's the weakest of the four major indices. So the strongest right now is the Dow Jones. Small caps are number 2. S&P number 3, and then the NASDAQ 100 is the weakest.
Okay. So with this information, how do you plan your stock identification?
Stop identification is generally, when I first started, I used to use ATR, average true range, but that led to some lopsided positions where I had way too much in one and not enough in another. So what I generally use now is a fixed percentage stop. So with the Oxy, we'll go back to Oxy, since that's a new position for me. And I basically use a 10% stop from my entry point. So what I try to do is I try to get in at a level where my stop loss is underneath a support level.